show, everyone. It's called the Business to Business Network Show. My name is Barry. I'm the host and creator of the show. Business, politics, economics, and we've got about 50 different chambers of commerce to get a chance to call in and tell their business. We know they're listening because they love their free advertising. But we also want to make sure we talk about what's happening in the economy, and our next guest is going to do that. Our guest is Gene. Gene, give us your last name. Introduce yourself, please.
Sure. Hey, Rex, it's Gene Goldman from Cetera Financial Group.
And let's talk a little bit about economic forecasts, because that's what you guys do. Tell us what you guys are seeing into 2020.
Sure. It's a great time. Right now we just finished our mid-year outlook, and what we're calling our mid-year outlook is it's simply mixed signals. And mixed signals is that if you look at a lot of the economic data, some of the data is starting to cool down, whether it's manufacturing, whether it's consumer confidence, whether it's retail sales. But at the same time, data is still in expansionary phase. We are, if the economy expands through July, which it should, we'll be in the longest economic expansion since the Civil War. Great news. Second point, equity valuation. The stock market valuation is at, it's fairly valued, but earnings could weaken, especially in the second quarter and third quarter. And the third point is the treasury market, the bond market. Short-term yields are higher than long-term yields. We have an inverted yield curve. This suggests that the bond market is concerned about the economy going forward, but at the same time, riskier debt like high-yield bonds, like corporate bonds, are trading very tight to treasuries, suggesting that great times are ahead. So as you can see, we have a lot of mixed signals going forward.
Let's talk about the elephant in the room, China and the U.S. and the trade war. How's that affect us?
Well, definitely affects us a lot. I think it affects consumer confidence. It affects inflation expectations. So many different ways it affects it. It affects our manufacturing data. We saw a data point that came out, consumer confidence. Consumer confidence came out today much lower than expected. And this is, again, concerns about tariffs, whether it's U.S. tariffs on China, whether it's U.S. tariffs on Mexico, which are now resolved. But again, it definitely affects our data. I think the positive news is that we do think it's going to be resolved very soon. Obviously, we have the G20 meeting coming up this weekend. Both the U.S. and China will be at the negotiating table. I think both sides are extremely incented to get this done as soon as possible.
And let's all hope and pray for that, because we really need the economy stable. Now, let's talk about how we should position ourselves as investors. Give us some coaching. What should we do?
Sure. It's, the first point, I wish I had a crystal ball to say exactly where the stock market would go by year end. And no one has that. But the only thing that we can accurately predict is that volatility will pick up, market volatility. Because as I mentioned, lots of mixed signals in the market, lots of headwinds and tailwinds are going to push stocks all over the place. Expect volatility to pick up. With increasing volatility, I would maintain a balanced approach. Don't be too risky in these markets right now, because valuations are near their upper end. And yes, there's some good opportunities, there's some good positives, maybe a U.S.-China trade war resolution. The Fed is on our side. Global central banks are on our side, but we're pricing perfection. So if your listeners are long-term, say a 60-40 investor, 60% stocks, 40% bonds, and given the strength in the markets we've seen, and now they're at 70-30 or 80-20, use the opportunity to rebalance to your long-term weights, because again, stocks can fluctuate up and down dramatically, and we clearly are in a fork in the road right now in terms of where the markets are going.
Okay, now let's get into the nitty-gritty coaching and education here. What you're saying, if I understand correctly, is 60-40. Was that 40% in bonds, 60% in stock? And educate us why that balance is important. Obviously, bonds are more stable. Stock is volatile. But what are you saying? Are you saying we need to keep it 60-40 or go 70-30? Say that one more time.
Oh, sure, of course. So what I'm saying is that let's say that you, your client, your listeners, they are long-term, they're a 60% stock investor and 40% bond investor, which is a good diversified, balanced portfolio based on your investment objective. If all of a sudden, stocks have been they've done very well over the last, 10 years. We're in the longest bull market ever. A lot of our portfolios today are at, maybe 80% stocks instead of 60%, or they're 90% stocks instead of 60%, because stocks have done so well relative to bonds. All we would suggest doing is basically rebalancing back to your longer term investment targets. As we all know, stocks are more risky than bonds. Stocks do well when the economy is doing well, when people are very optimistic about corporate earnings. And it's happening, it's been going on coming out of the Great Recession. Bonds, on the other hand, are a great anchor to a portfolio. They're very conservative. They tend to do well when stocks are weakening. Case in point was fourth quarter last year. The S&P 500 was down 14.5%. And bonds, on the other hand, were actually positive. It's a good way to diversify a portfolio. So all I'm saying to your listeners is, a lot of our portfolios have done very well because markets have done well for the last 10 years. It's a good time to rebalance back to your original weights. Take some profits, take some risk off the table, reduce some of that risk. Because again, we're in a fork in the road, and while we do believe the trade war will be resolved, anything can happen.
Okay, that was clear. 40% bonds, 60%. That's the balance. That's the rational. That's what you got to look at. That's the coaching. This has been fantastic. Where can we go to get more information?
Sure. We have a website. It's cetera.com, CETERA.com. We also have a Twitter page. It's Cetera, CETERA.IM for investment management. And we post tweets constantly about gold, about oil, about China. Our market outlook is there too. So CETERA.com, CETERA.com. Sometimes we say things so fast on radio, people really want to get more information. We want to slow that down. We really appreciate, Gene, what you guys are doing. This is good coaching, good education. Thank you so much, Gene. We got to do a commercial break. Everybody stay tuned. We're going to be right back.